Stop scrolling, because what I'm about to tell you could change how much money you lose or keep this year. The IRS just confirmed a new senior tax deduction that headlines are calling $47,500. But buried in the fine print is a Medicare rule that could quietly drain up to $300 every single month from seniors' pockets. And if you don't understand how these two things connect, you could be celebrating a tax break while your healthcare costs skyrocket without warning. So stay with me, because in the next few moments, I'm going to break down what's real, what's exaggerated, and what every senior absolutely must do before it's too late. If this kind of information matters to you, real updates that protect your money, your benefits, and your peace of mind, then don't wait until the damage is already done. Hit subscribe right now, because every week we break down IRS changes, Social Security updates, Medicare rules, and benefit alerts in plain, simple language so you don't get caught off guard. Subscribing takes 1 second, but missing these updates could cost you thousands, so tap subscribe and make sure you're always one step ahead. Let me help you understand what's really going on with these claims about senior tax deductions and Medicare costs, because there's quite a bit of confusion floating around on the internet right now, and I want to make sure you have the clear, honest truth. You've probably seen videos or articles talking about a massive $47,500 senior deduction from the IRS, maybe paired with warnings about a Medicare rule that could suddenly cost you $300 every month. It sounds alarming, and it sounds like something you need to act on immediately. But here's the thing, while there is some truth buried in these claims, the actual story is quite different from what those attention-grabbing headlines suggest. Let me start with the tax deduction part, because that's where a real change has happened, just not quite the way it's being described. The IRS has indeed introduced a new tax deduction specifically for senior citizens. This is real, and it could help you save money on your taxes. However, the amount isn't anywhere close to $47,500. The actual new deduction is up to $6,000 per person if you're 65 or older. If you're married and filing jointly with your spouse, and you're both 65 or older, you could potentially get $12,000 in additional deductions combined. This applies to tax years from 2025 through 2028. Now, I know you might be thinking, wait, where did that $47,000 number come from then? That's a great question, and it's where things get a bit tricky. Some people creating these videos seem to be adding together multiple different deductions and trying to make it sound like one giant benefit. When you're a senior, you already get a higher standard deduction than younger taxpayers. For 2026, if you're married filing jointly, your standard deduction might be around $31,500 or so. Then there are these additional amounts for being over 65, and now this new $6,000 per person deduction on top of that. But even when you add all of these together, you still don't get anywhere near $47,500. The creators of these videos appear to have either made a math error or, more likely, are exaggerating the numbers to get more views. Let me explain how this new deduction actually works in practice, because understanding this will help you figure out if it benefits you. Think of a tax deduction like this. It's not free money that gets handed to you. Instead, it reduces the amount of your income that the government can tax. Imagine you made $50,000 this year from your pension, Social Security, and maybe some investments. Without any deductions, you'd pay taxes on all $50,000. But with deductions, you might only pay taxes on, say, $30,000 of that income. The more deductions you have, the less of your income gets taxed, which means you owe less money or potentially get a bigger refund. This new $6,000 deduction works alongside your standard deduction, not instead of it. You don't have to itemize your deductions to claim it, which is good news because most seniors take the standard deduction anyway since it's simpler. However, there's a catch. This benefit starts to phase out if your income is too high. If you're single and your modified adjusted gross income is above $75,000, or if you're married filing jointly and your combined income is above $150,000, the deduction starts getting smaller. The higher your income goes beyond those thresholds, the less of this deduction you can claim. It's also really important to understand that this is a deduction, not a tax credit. The difference matters quite a bit. A deduction reduces your taxable income, while a credit reduces your actual tax bill dollar for dollar. and neither one automatically means you'll get money back. Whether you get a refund depends on how much tax you've already paid throughout the year compared to what you actually owe. Some of those videos make it sound like you'll automatically get a big check in the mail, but that's not how it works. The deduction helps lower your tax burden, which is valuable, but it's not the same as the government writing you a check for $6,000. Now let's talk about the Medicare part of the story, because that's where the second piece of confusion comes in. The claim that a Medicare rule could cost seniors $300 a month is referring to something real, but it's not new, and it's not directly connected to this tax deduction at all. What these videos are likely talking about is something called IRMA, which stands for Income Related Monthly Adjustment Amount. This is a surcharge that gets added to your Medicare Part B and Part D premiums if your income is above certain levels. Here's how IRMA works. Most people on Medicare pay a standard premium for Part B, which covers things like doctor visits and outpatient care. For 2026, that standard premium is around $185 per month for most people. But if your income from 2 years ago was above certain thresholds, you pay more. The government looks at your tax return from 2 years back because that's the most recent complete tax information they have. So for your 2026 Medicare premiums, they're looking at your 2024 income. The income thresholds where these surcharges kick in aren't that high, which catches some seniors by surprise. If you're single and your modified adjusted gross income was more than $103,000, or if you're married filing jointly and your combined income was more than $206,000, you'll pay higher premiums. The surcharges go up in tiers as your income increases. For someone at the highest income level, these extra charges can add up to about $480 per month on top of the standard premiums when you combine Part B and Part D surcharges. So yes, that $300 a month figure is in the ballpark of what some higher income seniors might pay in extra Medicare costs, though it varies based on exactly where your income falls. But here's the key point. This isn't a new rule. IRMA has been around for years. It's not something that just got introduced alongside this new tax deduction. The videos linking these two things together are creating a false connection. The new tax deduction doesn't trigger Medicare surcharges, and Medicare surcharges don't have anything to do with claiming this deduction. They're two completely separate parts of the federal system that happen to both affect seniors. In fact, here's something interesting. The new tax deduction could actually help you with IRMA if you're near one of those income thresholds. Remember, the deduction lowers your taxable income. If that reduction is enough to drop you below one of the IRMA threshold levels, you might avoid or reduce those Medicare surcharges. So in that sense, the tax deduction could potentially save you money on Medicare premiums, not cost you more. Let me give you a concrete example to make this clearer. Say you're married, filing jointly, and your income for 2026 is going to be around $208,000. Without any deductions, that puts you just over the IRMA threshold of $206,000, which means you'd have to pay extra Medicare premiums. But if you can claim this new $12,000 deduction for you and your spouse, that might bring your modified adjusted gross income down to $196,000. Now you're below the threshold, and you don't have to pay those extra Medicare charges at all. Of course, this is a simplified example, and your actual tax situation might be more complex, but it shows how the deduction could actually protect you from Medicare surcharges rather than cause them. So why are all these videos mixing these two things together and making it sound so urgent and confusing? Unfortunately, it's often about getting your attention. Online content creators know that big numbers and scary warnings get people to click and watch. A video titled "Small New Tax Deduction for Seniors" might help a little, and here's a reminder about existing Medicare premium rules. Isn't going to get nearly as many views as one claiming there's a $47,000 deduction that comes with a $300 monthly penalty. The exaggerated version sounds more dramatic, more urgent, and more important. This doesn't mean the people making these videos are necessarily trying to scam you, though you should always be cautious. Many content creators genuinely believe they're helping by raising awareness, but they may not fully understand the details themselves, or they may be oversimplifying complex tax and Medicare rules to fit into a short video format. The problem is that this oversimplification leads to confusion and sometimes to seniors making financial decisions based on incomplete or incorrect information. What should you actually do with this information? First, if you're 65 or older, make sure you or your tax preparer knows about this new $6,000 deduction when you file your 2025 taxes. It's not going to revolutionize your finances, but every bit helps, and there's no reason not to claim a legitimate deduction you're entitled to. Second, be aware of how IRM-A works if your income is anywhere near those threshold levels. If you had an unusual income spike 2 years ago, perhaps from selling a house or taking a large retirement distribution, you might be able to appeal your IRM-A determination if your current income is lower. Third, and perhaps most important, approach these kinds of viral claims with healthy skepticism. If something sounds too good to be true or alarmingly urgent, take the time to verify it through official sources like the IRS website or by talking to a qualified tax professional. The truth about most financial changes affecting seniors is that they're usually more modest and more complicated than the headlines suggest. Real policy changes rarely offer massive windfalls or create sudden disasters. They're typically incremental adjustments that help some people in some situations. This new senior deduction is a genuine benefit that could save you several hundred to perhaps a couple $1,000s in taxes, depending on your income level and tax bracket. That's real money worth claiming, but it's not going to transform your retirement finances overnight. As for Medicare costs, the best protection is understanding how your income affects your premiums and planning accordingly. If you're approaching retirement, or if you have control over when you realize certain types of income, like from selling investments or doing Roth conversions, timing these events with IRM-A thresholds in mind can save you money. But again, this isn't about a new rule to fear. It's about understanding an existing system so you can work within it effectively. The internet can be a wonderful resource for learning about topics that affect your life, including taxes and Medicare. But it's also full of oversimplified, exaggerated, or just plain incorrect information. The best approach is to treat viral videos and sensational headlines as a starting point for your own research, not as the final word. Check official government sources, talk to professionals who specialize in senior finances, and don't make major financial decisions based solely on what you saw in a social media video. Your financial security deserves better than that, and now that you understand what's really going on with these claims, you're better equipped to make informed decisions about your own situation.